Hello, welcome back. Hope you're having a nice day. A subscriber of our channel, Investors Heaven, asked to make a video about how to build a good stock portfolio. And I thought that this topic is actually super interesting. And I did want to make this video, but in order to do so, I created some slides here, a PowerPoint, that we can use to traverse all the topics that I wanted to talk about. And this took a little bit of time to make, and hopefully it can provide you with great amount of value here. And so if you are new here, you may want to consider subscribing because I'm making these kinds of videos that are aiming to help investors all the time. And if you are watching this video, please leave a like. That really helps a lot. And it's a little bit of a thank you for spending that much time making it. So thanks for being around. Let's start with this. So how to build a good stock portfolio here. And this is a topic that we need to talk about, and it has a lot of different things that we need to approach it with. And the first thing to talk about is the fact that we have to assess our financial situation here. And this starts with age. Obviously, younger people can afford to take more risk, and they typically have more years in front of them to invest. And so you may have heard of the rule of 72. I have spoken about it in my channel. This is a rule that actually divides 72 by the interest gained every year out of an investment and tells you how many years it will take for your capital to double. And so a 10% average gain, which is the typical for an S&P 500 index fund, for example, takes about 7.2 years to double. And so if you invested $10,000 today in an S&P 500 ETF, you typically expect it to double at about 7.2 years. And that's the typical figure, more or less. It's the average in the last 100 years or so. And so this implies that the younger you are, the more time you have, of course. And so you should have a little bit of a preference towards growth, because the more you make a year on a percentage, the faster you're gonna be doubling your money. And so as you have more years, time is with you. Now, older people, they need to be taking less risk because they're approaching retirement. And so they have more preference towards stability and more static income, and that would be dividend stocks and some value stocks that are, that can provide some income potentially, or even bonds in some situations, of course. Now, the next thing is we want to assess our risk tolerance, because not every person is the same. I happen to be more risk averse myself, yet I still want to be taking the steps to make sure that I'm taking as less risk as possible and go for as more reward as possible. And so, as you can see here, every investment has some risks that an investor should be willing to take. There is literally no investment that has zero risk, none at all. And we need to be we need to be picking good investments that are doing well financially and kind of diversify across sectors. And one of the very well-known methods to mitigate risk is to invest money that you do not actually need and that you do not actively need, really. And in many cases, an investment can actually go down like 30% for a year and then go up like 250% in the next few years. That happens a lot. And so if you're an investor that has invested money that you actually need, and you are getting like a 30% loss all of a sudden, you may be willing to and tempted to actually sell out of your investments, and that would be the worst thing to do, really. As long as you picked a potentially successful investment that is currently doing well financially, you should give it the time. And the best way to give it time is to not need the money. That's very, very crucial in investing, really. You have to bear that in mind when you are deciding to get into some investing, whatever that is. And so it is important to talk about the emergency funds idea. Investing is a process that follows the generation of extra income. That's really important. As I mentioned earlier, you do not want to invest money that you actively need. You need to make sure that you have saved at least 6 months of funds, if not more. I'd actually go for more. For instance, if you typically spend, like, let's say 40,000 a year, you should at least have 20,000 in cash. before you actually decide to deploy money in the stock market. Then that would be in excess of this money. Because things can happen in life all of a sudden, and you really don't want to be selling out of investments just to, just to spend it on your daily needs. Because that can actually take you into a situation that you need to sell out of your investments and sell for a loss for no real reason. So that's very, very important. Again, make sure that you invest money that you don't actively need. So, the intelligent investing principle. That's another well-known principle here. A known fact about intelligent investing is diversifying between stocks and bonds. And that's a discussion that can be a very lengthy one in terms of bonds today. But a well-known formula to use when allocating a percentage of bonds that you potentially like to buy is getting 100, the number 100, and subtracting it from your age, or actually subtracting your age from 100. And so 60-year-old person should hold 100 minus 60, which is their age, 40, which is 40% in stocks and then 60% in bonds. While a 20-year-old should hold 100 minus 20, their ages, equals 80% in stocks and 20% in bonds. This principle is very, very sound because bonds are way, way less risky than stocks, just because they are instruments that are paid as they're almost like somebody's taking a loan from you. This is exactly what it is, really, and they're paying interest back to you. And typically you get like government bonds or in some situations some municipal bonds, and these tend to be very, very safe. They have much less risk, but they pay less than stocks, much less. And so while the principle is sound, you need to make sure that you evaluate the current bond market, because when we're having low interest yields basically in the markets, so when there is a low interest environment, bonds pay much less. And so it may be actually better, it may make sense to even keep some cash, wait for a potential interest rise in this current environment, for instance, when we are potentially seeing bond prices rising because of the interest rates rising. This is going to happen for sure. And the thing is, you don't want to be buying bonds at a low interest rate environment, because the price of the bond is exactly inverse to the interest that the bond pays. And so the best time to buy bonds is when the interest rates are high and not low. And you can actually hurt yourself if you buy bonds when the interest rates are low. So it may look like you're keeping some money in the bank and gaining, you're actually getting some inflation in these and losing money, and that makes sense. But you can actually really hurt yourself in an environment where bonds go up massively, or actually at a good amount, and you have bought them before that move happens. This can really hurt you, because the bond prices will go down. The actual bond that you bought will still keep paying the same amount, but its price will go down if you want to sell it in the secondary market. That's a little bit of discussion to make, and I can make a separate video explain how bonds work. But typically, again, you want to be buying bonds when the interest rates are high and not low. So, stock investing here, diversification. And diversification is a very important thing, because it actually helps us make mistakes. And so if you are picture a rich person has a lot of different investments. They could have companies that are investing, that are actually doing business in, I don't know, oil, for instance, other companies that are doing business in real estate. And so if one of these businesses goes wrong, goes sideways, then they are losing, let's say, 1% of their portfolio. But then they have all these other investments working for them and potentially making even more money than what they lost there. And so for the same reason, we want to be diversifying in our investments here. Now, we shouldn't diversify just for the sake of it. No, so I'm not just saying that, just go ahead and buy everything from all sorts of different industries, because that can actually hurt you. It's typically a good idea to avoid entering, or not typically, definitely a good idea to avoid entering bad companies just because they belong in an industry. You don't want to be entering companies that are not making money just because they are, in the financial sector and you don't have any financials companies. You want to avoid that. It is also a good idea to avoid cyclical investments for a long-term portfolio. These investments can be good for a swing, like for holding a stock for a year or two, for example, and selling it out when a cyclical move happens. But it's not a good idea to do it for the long run. I tend to purchase companies of that sort when their prices are down. Like for instance, back in 2020, I purchased X, which is US Steel, when it was like $8 or something, and then I sold out of it a couple of months ago, where it was like 25. And I have to sell at some point because, again, this, if you take a look at the charts and how the industry goes, this is a cyclical investment. It goes up and down, and that's how commodities of that sort work. So bear that in mind. That's not for the long term, but it can be great for the for trading or for a swing. Index funds. Now, index funds are definitely near and dear to my heart because they are very, very important for a proper portfolio. You should always have some passive index funds in your portfolio and avoid all the active mutual funds. The reason why we want to avoid these mutual funds, these active ones, is they're basically having high fee rates, high fees, and there's no reason for that because they almost never really beat an index fund like the S&P 500 index fund, which typically makes 10% a year. So you will more than likely end up doing worse buying an actively managed mutual fund, more than likely. And this means that it takes, again, with a rule of 72, it will take about 14.4 years for your capital to quadruple if you set it up working for you in an S&P 500 index fund. Again, it's the rule of 72. Now, typically, I like to allocate a good portion of my portfolio to index funds. And this kind of allocation also changes with my age. I'm relatively young yet. I'm actually in my 30s right now. So I prefer to have a little bit of an allocation, but I'm not going, all in with that. As I grow in age, as I become older, then I'm gonna be allocating more. But for now, I like to have like 40 to 50% in low fee index funds, really, like VOO or VFIAX, or the Admiral shares of the Vanguard fund, that is. So, what about companies and stocks? Now, this is the thing that I love the most. I really, really love analyzing companies, and I understand the benefit of this because if you are actually discovering good companies that will be doing well, you can make much more money than you would be making out of an ETF or an index fund. Now, of course, an ETF or an index fund like an S&P one has less risk, but we can mitigate this risk by actually analyzing the companies and seeing what they're doing financially. Then we have much less risk. And as long as we keep diversifying and also have index funds in our portfolio, then I really like investing in companies as well. And actually, my biggest investments are in companies right now and not in the S&P 500. And again, as I mentioned, this also has to do with my age right now. So, as you're becoming a more sophisticated investor, the thing that you realize, and that's very, very important to realize in this video, every investment that you make is about the future cash flows discounted for today. So, the future cash flows an investment vehicle produces, whether it is a real estate, whether it is a stock, whether it is a bond, your investment is worth the amount of money that is going to be returned to you. And that is when discounted for today, because there is also inflation in between all these years that you're going to be keeping this money, that you're going to be making this money in. And so, for example, if you're thinking of, let's say that you're thinking of buying a company that is making $100 a year, right? Every year. And you have some given value at hand, like, this company is going to be making $1,000 in year 10 from now. And so, the value of this investment, as well as every other investment, as I mentioned, is the present value of all these future cash flows. So the thing is, $100 today is $100, but $100 in year 10 are not worth $100 today, because money today is worth more than money tomorrow because of inflation, and there is also some risk in some situations, especially in companies, for example. Now, in this example, we have a steady $100 income, but that's not the case with most companies. So it's much, much tougher to project what a real company will be doing in year 10. So this is just an example here. So you can understand that that future cash flows have a less present value because of inflation and risk. Therefore, this is why in this channel you see me using a discounted free cash flow model a lot. And this is why I created the tool that actually does it automatically. And if in this example, if you actually take this $1,000 and calculate their present value, this could actually be $600. I haven't actually calculated it, but I'm pretty sure it's going to be around that much. About $600, let's just say. And so if you know that, then paying $200 to buy the company today, this company today, could be a good investment. But actually paying $700 to buy this company today is definitely a bad investment, because you are prepaying for less than what you're going to be making. And even though it sounds that you're making $1,000, you are actually not making $1,000 because of the reasons we talked about earlier: inflation, risk, and basically making money in year 10 and not year 1. And so the exact same principle is true for the stock market and any investment, everything. The only thing that changes here is public companies tend to have higher multiples, and this is why you are looking at multiples of 15. This is the whole thing about a PE of 15 or a PE of 20. We are allowing the companies to have a multiple of 15 or 20 because they tend to be growing much more than your typical company. They are public companies, they are well-known companies, they are big companies that tend to grow more. Now that doesn't happen in every situation, of course, in every case, but it happens in many cases, and this is why we're willing to pay more for companies of this sort. And now, how about choosing companies? Now, it is generally a good idea, as I mentioned, to diversify between sectors. And take, for example, might seem today that it's the best thing, the hot sector. However, every sector tends to have declines, and again, sectors are cyclical too. Tech could be a thing of today, but I don't know, maybe materials could be a thing of the future. So never, put all your money into a single industry. Just try to have a few more industries, but do not overdo it. Like, do not buy industries for the sake of it. You can actually see here that the S&P 500 breakdown for 2022 involves more of a 30% in terms of information technology, like 13% on healthcare, and you will see the whole list here. This is what I would probably go with. I would try to get companies that are similar to this S&P 500 breakdown in terms of industries. I don't want to have like a very exact number. I want to have some weight. I don't want to have as many utilities as information technology, for example. That makes sense, right? I want to have a little bit of everything, but the allocation changes. And the S&P 500 gives me a very nice breakdown in terms of the allocation, the required allocation that would make for a nice portfolio. So, what about dividends? What about dividend paying stocks? So companies that are paying dividends can be very enticing because you are making passive income. But I want to point some dangers as well as some advantages of holding these companies. And for a while, dividend paying stocks tended to be my thing. I liked them a lot. And then I stopped liking them. Let me explain why. So they have advantages, yes, and some big ones. And I actually do still have dividend paying stocks, but they are not my core holdings. So they can provide a source of passive income, which, if retrieved from good companies especially, can make for great gains throughout many years. They are also a solid choice for investors who are approaching retirement age, and I think that's actually the best case. If you ask me, I think that's probably the best reason really to hold dividends paying stocks if you're approaching retirement. Especially stocks that are having low payout ratios, very important. Make sure that they will not cut down on these dividends, because if the payout ratio gets too high, they will have to cut down on it if they are not making enough net income to sustain the dividend. And then you are going to be finding yourself having a low passive income and a declining stock price. Not good. They can also be reinvested, and typically when you are investing with a broker, you will see that brokers offer DRIPs, which is like dividend reinvestment programs, which automatically reinvest the dividends to the same company, the same stock, thus actually adding more stock and trying to get an avalanche of stock for the specific instrument that you are holding. And it's a good idea. That's typically what I do, but not with all my dividend paying stocks, because in some situations I actually want to get to allocate them differently. It depends on how much I have of one, or potentially whether one is too expensive than the other. But it can be convenient. And so you can set this and forget it for a while. Yet I'm a little bit of a more active investor, so I kind of like to take things into my hand much more than have passively managed things. So they can also provide exposure to industries like real estate, for example, with REITs or MREITs, which are like mortgage REITs. And you can get money out of mortgages pretty much and rental payments, which is both interesting, very, very interesting, and can actually provide you with passive income without the need to hold the underlying asset, like a real estate, for instance, like a rental real estate. And dividend companies tend to suffer less fluctuations when markets are down, and generally speaking, that also means that they don't go up that much. Now, this has to do with what kind of company we're looking at, because a lot of these companies are just paying dividends and they are horrible companies and they don't make good cash flow. And they still go down a lot, so they can still fluctuate a lot. But if we're looking at big companies, value companies like, for instance, J&J, Johnson & Johnson, that is, for example, which is a dividend-paying company, then you are looking at companies that are much steadier in terms of their price movements, and they don't tend to move a lot. So bear that in mind as well. What about the disadvantages? One of the core disadvantages, they are tax inefficient, they are double taxed. Dividends are actually taxed when the company gains that net income, so they are taxed once for the company at the company level, and then they are taxed when they are distributed to you. And the amount that you pay has to do with where you are living and all that. But the fact that they are double taxed makes for an inefficient scheme here, which I don't like myself. Now, companies that pay out dividends, they do not grow that much just because they are allocating their cash flow to investors and not to within the company. And this is something that I also don't like that much, because I understand that if the company actually allocates the cash flow that they are making in growing the company, then I can actually make more from the company growing itself, and without having to actually get that cash, extract that cash out of the company. And also, something that's very, very important, a dividend cut can really devastate you, because it can affect the stock price, it can really drop it massively, and it can actually get you stuck with a decreasing dividend income. And so now you're having a decreasing stock price and less dividend income. And so what are you going to do? You're either going to sell at a loss, or you're going to have some money that's stuck there forever paying you nothing. So that's the core reason why I don't like dividends that much. Again, if we're looking at steady companies, this may be better or worse if we're looking at companies that are not steady. But in some situations, I'm okay with buying dividend-paying stocks. Yet I want to be buying companies that are like dividend kings or dividend aristocrats, meaning that they have been paying consecutive payments without decreasing them for like 30 to 50 years. But typically speaking, I normally tend to avoid buying more dividend stocks. I do have some, but unless it's a really good company, I kind of tend to avoid them. Investing in value and growth, which is my thing, I personally prefer to do that. Companies that can achieve good growth while making sure, and that's crucial, that I'm not overpaying for them. And so this means that we're looking at companies that have increasing revenues and net income. So they are making money out of sales, and they are actually keeping money from these sales. Net income is the profit after every expenditure is counted in. They have managed levels of debt, and so they don't have that much debt. I do want to see debt in a company. That's important, because debt helps the company leverage its growth. It helps it grow faster, but I don't want it to be outrageous debt that can actually, bring a company to its knees and potentially cause a default, of course. Decreasing or steady outstanding shares, I don't want any dilution, because I want to be owning the same amount that I owned when I bought the shares, and not less than that. And so if a company is increasing outstanding shares, that's not good for me. It's diluting me. I don't want to see increasing cash flow, which when discounted for today basically, points to an undervalued or fairly valued company, and that's at the time I purchased the stock, of course. And we're gonna talk about it, and that's what I do in this channel. If you haven't watched, you may watch a lot of my videos. Really, it's one of the core principles, one of the core things I'm working on when I'm analyzing a company. A clean balance sheet that gets better and better, increasing the total assets of the company, and it has relatively little or well-managed debt is what clean means in this situation here. And now we're gonna take a look at a concrete example, and you're gonna see how I tend to analyze companies here. What's the methodology, and what would get me to include a company in my portfolio. So let's say I'm an investor today, and I'm thinking of either buying Facebook or Shopify. And that could, of course, be 10 more stocks. We can analyze as many as we want, and this is what I'm going to be doing now. Which of the two is objectively the better investment? And I like both companies a lot. I'm not going to be picking a company just because I like the name. I'm going to be picking it because I like the financials. And this is what we're going to do now. I'm going to use the exclusive tool that we have here in Investors Heaven. At some point, this will be available to you as well. But let's take a look at it and see which of the two is the better investment now. And so now we're back to the tool, and you will see Shopify. This is what we start with. And Shopify's P/E ratio right now is sitting at 32 almost, which is relatively high. We typically want to see something below 20, but it's worth noting that before that it was actually negative, which meant that the company was losing money for a while. The price to free cash flow ratio is a figure that tells us how expensive the company is based on the free cash flow that they are making. And in this situation, we're looking at a company that is very expensive based on the price to free cash flow. How much expensive, we're gonna investigate later. The outstanding shares here are also increasing, and this is why you see an X here. They are increasing, and so this means that we're getting diluted, and this is by how much. That's not a good thing to see. The nice thing is that the 5-year revenue growth is increasing, and the net income growth is also pretty great. So the company is massively increasing its net income growth. But don't get trapped by this, because we have to pay for this, and we want to see how much we are called to pay for this. Now, there are some other things here, but I'm not going to be spending the time for this. We're going to be doing these things individually when we're looking at a company. But for this one, this is good enough what we're examining here. And so then we're going to our stock evaluation tool here, which gives us a story of the company's financials. And we're going to use the averages to project the next 5 years of the company's growth. And so this is going to be projected based on what the company has been doing. So this is not like a random projections here. It's based on the revenue the company has been achieving. For instance, you can see all these here, the last 5 years from 2017. And so you see that the average 5-year revenue growth of the company has been 65%, which is great, amazing. Now, when we're doing our projections, we're going to have low, medium, and high ones. We don't want to go overboard because we're projecting for the next 5 years and we don't know what's going to happen. Plus, we want to be conservative regardless, because that gives us a better price. So we have a higher margin of safety. So I'm still going to go relatively high here because I think the company will be growing nicely. I'm going to say 20, 22, and 24. Notice that this is still way lower than what they are doing here though. Now, the net income margins have been a little bit all over the place, but you can understand that because the company wasn't profitable for a while. So we could expect something in this region here. So I'm going to go, maybe let's go 15, 20, and 25 here. And the free cash flow margin is, for the most part, we can go something like 20, 25, and 30. And the annual return points to how much I want to be making out of my investment a year. And since I can make 10% on an ETF, an S&P 500 ETF, I'm going to go for 13 here, is what I typically like to use. And then I hit calculate. And now we're looking at a company that, even with our highest estimates here, we should be willing to pay at most $107 in order for these projections to fulfill themselves in 5 years. And so you will see that the current price of the stock, however, is at 700, which we kind of got a hint for previously when we examined the price to free cash flow. So it's very, very expensive based on what it is, based on what it's doing financially. And even though I think they're going to be doing awesome in the next few years, I just can't pay that because this is not a good investment for me. I love the company, but it's not a good stock for me to invest in. That's the whole point. Now let's stop this and take a look at Facebook, the second potential pick. And so now I'm back to the stock analysis tool. And now we're taking a look at Facebook or Meta platforms. And as you see, the P/E ratio is 15 here, is much better than what Shopify was. And now we're green. Anything below 20, the tool will signal as green, as you can see here in the explanation. And the price to free cash flow also 15.3, another great figure. And the outstanding shares decreasing, another great thing that we want to see, because now our stock is worth more than what it was worth back in 2019, for example. Why? Because there's less of it. There's less of it. Less of one thing means that if we own it, then our ownership is more of that thing. Now, great revenue growth as well, and great net income growth in the 5 years. Now, that's not as great as Shopify was. If you remember, Shopify was insane here. but we have to actually factor the price of the stock as well. And this is why we're going to go back to our stock evaluation tool here for Facebook, and we're going to do the same process here. We're going to go and examine the revenue growth of the company. You'll see here all the averages, and we're going to go with something like, let's go like 18, 19, and 20 here. Again, these are the averages. A net income margin of, this is very typical for Facebook, it looks like. They seem to be at about the same range. Still, I'm gonna go like 25, 27 and 29 here. And the free cash flow margin also at a very similar range. And this is one of the things that you really need to strive for. This is great to see from a company, because this means that they get an expected amount of revenue. This expected amount of revenue converts to an expected amount of profit, which is the net income. And this is what margin tells us. And then from this net income, we're also getting an expected amount of free cash flow. So no surprises here, no hidden facts from the balance sheet and the income statement of the company. That's very important. I like to see these kinds of values being similar. The free cash flow margin that I'm going to be using here, again, it's typical. This is the only one out, kinda. So we're going to go 80, 85, and 90. And again, 13% is the same that I'm going to be using here. That's how much I want to be getting. And I can hit calculate here. And you notice that with Shopify, everything was red. Now we're actually green at every estimate here. And our low estimate is actually almost $70 below the current price of the stock, pointing to a company that is undervalued. And our high estimates are pointing to a company that should be priced for $100 today. That's the price to pay today, by the way, not what it's going to be in the future. This means, if you are new to this, it means that if you pay today $279 at most, while the current price is $216 really, so it's actually more than the current price. This means that you are going to be getting this kind of projections for the next few years. Meaning that if the company grows at 18% with a net income margin of 25% and a free cash flow margin of 80%, you're going to be getting 13% of gains out of the company. And again, that's based on mathematics. It's the financials of the company, based on the free cash flow, based on the actual money that the company is making. And so as you can understand, the more years you hold into this company, even if there are some years where the trend is not great, eventually, because the company is making money, you will be making this amount, if not more than likely even more. And this is why I like to buy it when they are actually underpriced. So in this case, we're actually also getting a margin of safety here, which is about $70. Very crucial as well. And so this is how I like to analyze, and this is how I like to add companies to my portfolio if I'm looking at individual investments. This is why this kind of tool really helps me evaluate and take decisions. And initially I used to do it with spreadsheets and things of that sort, but it can be very messy and error prone. And this one really helps me have everything in one place. At some point, as I mentioned, this is going to be open to probably Patreons, and I will be giving access to all of you that are interested in using the tool. So, hope you enjoyed the video. This was lengthy and took a lot of time to make. Again, if you reached that far, please leave a like, please subscribe. That really helps. And I really hope you enjoyed it and it helps you with your investing. It just gives you some ideas and helps you build your dream portfolio. Thank you for watching the video. This was lengthy, and thank you for being around. I'll see you in the next one. Bye bye.